Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Happy Thursday. It's February 8th. We're here in our studio with actually a really good guest today. Danielle Shay from Simpler Trading is going to share with us some of the charts she's looking at as the S&P teasing that 5,000 level. I mentioned playing my horn on the air when the S&P closes above 5,000. Today's not the day. We're keeping it in its case. Maybe the beginning of next week we'll bring it back out again. We'll see how the remainder of this week plays out. But obviously, no doubt we've seen strength in the market up until this point. S&P 5,000, a pretty major milestone. This would be the first time, if and probably when, not if, we close above that 5,000 level as early as Friday's session. It's possible. The question I have, though, which we'll talk about with my guest today, and also I would encourage you to think about, is what's the potential for further upside beyond 5,000? That's what, not much keeps me awake up at night, but that's one that would actually do so, which is, what's the further upside? And that's where I think you want to think about potential reward versus potential risk. And there's very much potential risk here in the seasonally weakest part of the year, certainly in February, March of an election year. Let's get to the charts in our market recap. Talk about that S&P testing 5,000 and what it might look like. Before we get to the chart, by the way, let's answer a poll question we asked you recently. Will Tesla retest its 2023 low, it's around $110, in the year 2024? Now, this is an interesting question because it forces you to think a little bit about probabilities of a stock going all the way down to retest its previous low, or its previous year's low around 110. 57% of you saying yes, which means 43% of you saying no. Let's take a look at the chart here. And if you think about it, Tesla going down to 110 feels like a long way away, and indeed it is, right? I mean, going from 190 where we closed today down to 110, that's a pretty big 80-point haircut out of $190 stocks. That's a significant drawdown. And to be honest with you, before we'd be able to get there, we'd also have to break below the previous support level around 155, 160. So a long way to go down there. But the reality is Tesla at this point in a downtrend, right? And that's not a judgment call. That's not a, do you think Tesla is going up or down? This is, I think, really the benefit of Charles Dow's approach, which we call Dow theory, which is take a step back and look at the highs and the lows. And are they getting higher or are they getting lower? And from July of last year to now February of this year, we have a pretty clear pattern of lower highs and lower lows. Now, that changes when we start making higher lows and we start making higher swing highs, but we'd have to improve quite a bit to get anywhere near that point where you could, I think, legitimately define Tesla as in an uptrend. Until then, the trend is down, which means 110 getting closer as we continue this stepwise motion. So when you're looking at the chart of Tesla, it's been oversold up until this week. Do we get a bounce here, maybe filling that gap, pushing back to retest those previous highs, even up to the moving average resistance around 230 or so? Possibility certainly is there. But I would say overall, as long as we remain making lower highs and lower lows, this is a chart in a downtrend. And think about the possibility of getting down to those previous lows. What would you need to see if you're holding a Tesla? What would you need to see to tell you, you know what, get out? It's not a great time to be owning this stock. Hopefully that poll question made you think. And don't forget to follow us on the social media accounts. And here, of course, on YouTube, you subscribe to our channel, you'll get the next poll question. Continuing on here with our market recap, boy, we're so close to 5,000. I mean, just a hair's width away from 5,000, but not to be. The hats will have to go back in their cases as we wait for this major milestone. It certainly seems like it's going to happen here very, very soon. But interesting to see how the S&P has literally towed the line here for a couple sessions this week, not yet breaking above 5,000. Again, my concern is what's the likelihood of much further gains, right? If we do get above 5,000, what's the chance we go to 5,100 or 5,200 before we have a big time pullback? And I would say very, very low. That's what the breadth conditions, which we'll talk about here in a moment, are certainly suggesting. And by the way, we did get a minor signal from this thing called the Hindenburg Omen this week. I'll show you that here in the next chart or two, talked about what that might mean, because that's something we should, we haven't talked about that one in a while because we haven't had a signal. It's maybe happening here very soon. S&P was basically flat for the day by the end of the day, slightly higher, excuse me, just a couple points, around 49.98 is your official close. The mid-cap and small-cap indexes doing a little bit better. And if you look at the sectors at the top of the list, like energy, real estate. These are things that when those are the sectors that are working and growthy sectors are not doing as well, you're going to get mid caps and small caps probably outperforming. But the S&P 600 small cap index, nice to see it in the green today, up about 1.3%. The S&P 100 large cap or really mega cap index also flat for the day. The VIX moving slightly lower. So you have a flat S&P, a briefly or a narrowly positive NASDAQ composite. VIX moving lower, which basically means we're kind of in a treading water kind of feel right now for our equity benchmarks. Looking at the bond markets, a lot of interest rate measures in the green, and that means rates are moving higher, means bond prices are moving lower. So the 10-year yield finishing just below 4.2%. Your long bond yield is around 4.4%, and the 5-year point is just above 4.1%. Now, of course, the short end of the curve still quite elevated relative to the rest of the yield curve. This is, basically a byproduct of the Federal Reserve and the FOMC, the Federal Open Market Committee, raising the short end of the curve. They control basically the shortest end of the curve, which is where they are lending money to banks, where banks are able to borrow and lend money to each other. That's the point in the curve that they control, and by doing that, they're able to have these ripple effects that go through the economy and certainly affect the rest of the yield curve, which impacts all of us when we're trying to do anything that involves raising capital or getting a loan or buying a house or anything like that. So interest rates today moving higher. Think about inflation and interest rates, I would say, as headwinds and tailwinds. We always want to think about a direct relationship. If rates go up, what does that mean for stocks? What you have to remember is it's just not that cut and dry, right? It's not that direct of a relationship as much as we might want to oversimplify. So rates going higher, basically more of a headwind for growth stocks. It tends to be less. Growth stocks tend to do less well when rates are going higher because it's making those stocks basically less attractive in terms of their future earnings. So overall, something to keep in mind for sure. Bond prices, I mentioned, going down. The TLT down about 0.6% from yesterday's close. Looking at commodities, the DBC, which is a broad commodity ETF, really geared more towards energy than anything else, moving up. Oil prices actually moving higher. The USO, which is a crude oil ETF, up about 3% today. Natural gas prices actually moving lower. Gold and silver really mixed, with silver prices moving to the upside, but stronger crude oil prices really helping the energy sector to the top of the list today. Finally, cryptocurrencies. Bitcoin actually pounding away a nice little set of gains here recently. We're up around 45,340. That's up another 2.25%. Ether prices are essentially flat from yesterday's session. You can see mixed results from the rest of the top 10 cryptocurrencies that we track. Bitcoin's really the main one that I follow. Ethereum second to that, and then the others much less often as part of my day-to-day process, unless I have a reason to really dig into one of these in particular. But overall, I think Bitcoin and Ethereum are good sort of proxies for the general cryptocurrency space and looking for strength there. Bitcoin not too long ago was down around 38 to 40,000. It's really like 39 to 40,000. That was on the most recent pullback after the Bitcoin ETFs were finally launched. Now you're actually seeing those come back up. So what's interesting is Bitcoin ETFs were released. Immediately, that's the peak in Bitcoin for now. Prices come down. Now you're actually starting to see them rotate higher, which means all those people buying those new Bitcoin ETFs maybe starting to sit on some paper profits. We'll see what sort of profit taking we have as we go through this first rally post ETFs being released. Looking at the 11 S&P sectors, we can see energy at the top of the list up 1%, real estate number 2 up 0.6%, consumer discretionary number 3 up 0.4%. You can see the XLY, XLC, XLK were 3, 4, and 5, all positive for the day, but not by much, not a huge up day in any of those sectors. On the downside, utilities down 0.7%, financials, healthcare as well, so about half and half between sectors up on the day, sectors down on the day. The Keller market model now featured as part of the new, what we're calling panels, our new upgraded dashboard. And by the way, if you missed our show, boy, when was this? On Monday, I want to say, we talked about some of the newer features on the Stock Charts platform, just the beginning. We have a lot of really cool things in the development queue. I'm excited for our engineers to start to build some of these things out. Some really cool stuff that I hope will enhance your ability to understand these markets. Things like this, which are just quick visualizations of market conditions, for me, have really become an important part of my process. This is the first iteration. We'll improve it from here and add some cool features to this. But very quickly, what you've noticed through the course of the week, the short-term model, medium-term and long-term have been bullish across the board for all of these groups, from large caps to small caps and the NASDAQ as well. But what's happened this week is briefly earlier in the week, the mid and small cap turned negative in the short term. By today, at today's close, both of them back up to bullish green. So my dashboard is saying bullish across the board, and that's certainly what it feels like in terms of defining the trend up until now. It's sort of a thumbs up upward trend for our major benchmarks, and really the growthy stuff that dominates our growth-oriented benchmarks. Let's look at a daily chart of the S&P 500 and check in on what happened today. Not much when you think about the overall trajectory. I mean, the phase of the market has been bullish. We're in a pattern of higher highs and higher lows. Today really didn't make any additional gains after yesterday's gap higher, but we are, yesterday and today literally right up against the ceiling, the 5K ceiling. At some point, maybe as early as tomorrow's session, we get up and close above 5,000, but it's not happening just yet. And I think when a trend is in place, as we are seeing now, right, when the primary trend is bullish, meaning sort of that main time frame, for me, when I say the primary trend, it's whatever kind of that main time frame it is for you and what you're looking at, currently positive, meaning we're in a pattern of higher highs and higher lows on the main daily chart that I'm paying attention to. Primary trend is up. So what would tell us that the trend is no longer up? Well, we already know that the market's going higher. So new highs should not be a surprise. That should actually be an expectation as long as the uptrend is in play. And then you randomly have pullbacks. And as long as we keep making higher lows on those pullbacks, that primary uptrend is still in place. We have a really interesting trend line to watch now. We used this original trend line in late October to mid-December. You can see we broke that trend line there in mid-December. We had a sideways period of about 4 weeks. Then we continued the uptrend to the upside. The most recent pullback here at the end of last month actually lines up really well with a trend line if you draw it off the October low and the January low. You can see that lines up almost perfectly with the low from late January. Now, we have a pretty good visual representation of the pace of this trend. And I would tell you the way that you think about this is look for the price to break below that trend line support. And until it does, things just aren't getting that bad. Even if you're concerned about what's happening, if you're not sure what's happening, I tell you what, as long as we hold above this green trend line that I've drawn, the trend is up, the trend is bullish, and that's kind of the condition that we're in right now. So be patient if you're nervous, if you're concerned about how thin the air up here is up here around S&P 5,000. Look for signs that the trend is changing, what we call a change of character. And for now, you have strong momentum, you have a stock market going higher. Breaking below that trend line could be that initial warning that things may be getting worse. Now, we've talked about some of the breadth conditions, and I'll show you some of the charts that we've highlighted at times. Here's the percent of stocks above their 50-day moving average. As January, now going into February, has been so significantly strong, take a look at the bottom panel, which is the percent of stocks above their 50-day. When S&P 4800 was a level we were talking about, speculating whether we would get above there, that was at the end of last year. We had 90% of the S&P members above their 50-day moving average. As of today's close, that number's down to 65%. So to rethink that, right, from the end of last year to where we're at now, about 5 weeks later, literally a quarter of the S&P 500 members used to be above their 50-day and now have broken down through their 50-day. Now, the S&P is nowhere near its own 50-day moving average. Now, why is that? Well, that's because stocks like Meta gapping higher 20%, the NVIDIA moving higher, all of those mega cap growth names doing so well. There's such a big weight in our benchmark that they're able to hold the S&P up quite high. And that's why the S&P is nowhere near its own 50-day moving average. It's about 300 points away. But what this indicator at the bottom tells you is about 25% of the S&P have done this. They've actually broken down through the 50-day already. So when we talk about breadth conditions being strong, I don't see that. I actually see breadth conditions getting worse over the last couple weeks, indicating that a lot of individual names are breaking down. By the way, quick question, quiz for you. The top 10 stocks in the S&P, Apple, Meta, NVIDIA types of names, think about how big they are in terms of their market cap. How many stocks, if you start at the bottom of the S&P, how many stocks would you have to get to equal the weight for the S&P? How many names would equal the weight of those 10 largest ones? You know what it is? I ran the numbers actually earlier this morning, 420. So what that means, to be clear, is the top 10 stocks, those apples, those top 10 mega cap names, are about the same weight in the index as the bottom 420 stocks. That's how lopsided, that's how top heavy our benchmarks have become as the growth trade has worked so well, as the AI frenzy has gone higher. Those names, those leading names, have gotten bigger and bigger, and there's such a big weight that all the smaller names really aren't even a slight impact on the benchmark relative to those mega cap names. That's how the market can go higher if those mega cap names are working. And even if a lot of individual names are no longer working, the S&P can still go higher because they're just not driven by this. But it does suggest if people are selling out all those other positions, that's usually not a good sign. It tells you that things maybe are starting to get a little squirrely, for lack of a better adjective to describe this market. Now, we actually did get a question through the Final Bar mailbag. We're not going to probably have time for it on our next mailbag episode, which will be on tomorrow's show. Friday of this week, we'll do an all mailbag episode hitting some of the great questions we've received from all of you. We did get a question. I wanted to address it. We won't have time for it probably on the show tomorrow, but we actually did get an initial reading from the Hindenburg Omen. Now, I'll spend a minute here just describing this, and we've highlighted this one before, but it's been a long time just because we haven't been in a point where we've gotten these signals. The Hindenburg Omen is a bearish sign for the market, as implied by the name. The Hindenburg sort of alludes to the famous disaster. And then the Hindenburg Omen was named basically for a series of market conditions which often happens at major market tops. And usually right before the major market top is confirmed, you get this Hindenburg Omen. Now, it basically has a series of 3 different inputs, and I will summarize it as such. Number 1, the trend has to be up. So this only happens during a primary uptrend. There's a particular setting it looks for, and that has been satisfied currently in the market. Second thing, you need to see a number of stocks moving higher and a number of stocks moving lower at the same time. Jim Mieka, who actually created this indicator years ago, thought that at a major market top, there's indecision, and there's a bunch of stocks going up, a bunch of stocks going down at the same time. So that's question number 2. The third question is the McClellan oscillator has to break below 0, as we highlighted earlier this week. That's actually happened this week. The McClellan oscillator had been above 0. That breaking below 0 means all of a sudden you have a strong uptrend. All of a sudden you have indecision because stocks are breaking out and breaking down at the same time, and you actually have the McClellan oscillator going lower, which means the breadth is starting to turn negative. That actually triggered as of yesterday's close. Now, if you look back, you'll find a number of random times where you get one signal. What you have to remember is a key part of Jim's approach was you had to have multiple signals from the Hindenburg Omen, multiple sell signals within, I think, a 30-day period was what Jim originally came up with. So I've highlighted with this purple shading when you've had that condition where you've had the 3 factors that have been qualified and it's happened at least twice in 1 month. And you can see the last 3 times that's happened: December 2021, March 2020, August 2019. Those are basically your 3 major tops going back over the last 5 years. This is why the Hindenburg Omen does not fire very often. When it does, you really want to be familiar with it. For now, we have had the initial reading, which means keep an eye on this chart. And in the coming weeks, if we get one more sell signal, that would be a big sell signal, the likes of which we haven't seen since the end of 2021. So thanks for that question that one of you sent in. You're absolutely right. This indicator, by the way, exclamation point BINYHOD. You can add those to your chart, and we'll include this as one of the charts in the comment section below the video. Make sure you copy that to your log and keep an eye if we get another signal of a value of 3 here in the next couple weeks. Just to finish off here our market recap, let's look quickly at the chart of Bitcoin, because I just want to mention we're obviously seeing some improvement in Bitcoin. What happened was you had this nice long-term rally. The primary trend has been positive for quite some time. In full disclosure, I do own some Bitcoin and some GBTC in accounts that I manage. And overall, I think the long-term structure is still healthy, but this spike right here, when we got right to around 49,000 and then came right back down, that was literally the day that those Bitcoin ETFs were finally approved. There's all this speculation during this period about when and if the SEC would finally approve Bitcoin ETFs. It happened, and for now, that has been the peak in Bitcoin. We sold off aggressively from around 49,000 to almost 38,000 in just a couple weeks. That's how quickly the market basically gave back a lot of those previous gains. The Bitcoin price found footing at a big round number of 40,000, not surprisingly, I would say, and now has rotated back higher. And this week, we're now actually seeing it break out of a shorter term pattern, which I'd probably label a pennant. Not easy to see on this chart, but on the shorter term chart, you'd see it. And now we're back in an uptrend. So getting back above the 50-day, I would say, is very encouraging. I am super focused on this green shaded area. That is now your January 2024 high. That's a Fibonacci retracement level just below 49,000. Also the big round number of 50,000 right there. So I think There's your upside target. At least that's the level I'm looking at. And a break above 50K really opens the door to a potential retest of all-time highs. That's up in the 60s, a little bit further beyond current levels for sure. To complete our market recap, just a couple names reporting earnings. So we have Monolithic Power Systems, is one of the semiconductor names. I feel like semiconductors continue to show evidence that we're gapping higher on semiconductors. Another name we'll talk about with today's, with today's guest, Danielle Shay. But overall, these are stocks that have had really nice moves up until this point. MPWR was actually consolidating. This is called an ascending triangle pattern, where we have a consistent resistance level and a pattern of higher lows. We gapped higher above that today, up another 14% today. I think it's really tough to chase a name like this as it's gapping higher, but overall getting above that gap and holding 650, pretty meaningful. For now, that's a chart I would keep an eye on. And we have to go with Disney. I actually put on social media. I took an image of Goofy, which lined up really well with the price action. So follow me on Twitter at DKellerCMT. You can see that one, but really mapped beautifully to the price action. That illustration aside, I think getting above $100 a share is pretty interesting as well. These are some of the names we're going to talk about here with today's guest to wrap up our market recap. We have a really good guest today, Danielle Shay from Simpler Trading. Here in a moment, we'll talk with her in our interview set, going through some of the charts she is watching as we tease that ever-important S&P 5,000 level. Before we get there, just a quick announcement. As a reminder, we love hearing from you. We love the feedback that you've shared with us about our show, about our guests, but we especially appreciate your questions. We'll do an all-mailbag episode tomorrow, and for the next all-mailbag episode, I'd love to answer one of your questions here on the show. Our email is thefinalbar@stockcharts.com. We're on the Twitters at FinalBarSCTV, and on our YouTube channel here, of course, just drop a comment below the video that you're watching. We'd love to hear from you, and we'll hope to answer one of your questions in our next mailbag episode. All right, we're over in the interview set. Very excited to welcome on today's guest, Danielle Shay. Danielle's the Director of Options at Simpler Trading, now a local resident here in the Pacific Northwest. Welcome to this area of the country. Good to have you on our show again today, Danielle.
Thank you so much for having me. I love joining you, and it's fantastic being in studio.
Just a quick drive now to get down to Redmond now, which is awesome. But you have a pretty good setup out in the islands there in the Puget Sound. So welcome to this area, and let's get into some of the charts here. The S&P 500 pushing 5,000. We're sort of teasing that level this week. As you take a step back and look at the broader market conditions, what stands out to you?
So when I look at the S&P right up at 5,000, I mean, this is just such a key psychological value and heavy area of resistance. And so when I'm looking at the market right here, I feel like it's been incredibly strong this year, but we're running into a ceiling, right? And so you need to be cautious. I've been taking profits on a lot of my longs. I am getting ready for a pullback. I will tell traders that I'm slightly hopeful that we get a high volume breakthrough of 5,000 and then we just get this, massive rush higher. But for the most part, got to be careful.
You're emotionally prepared for the breakout, but you're cautious. I think, that's an astute way of approaching this. I think that's good. How much? I mean, so seasonally, we're in a weaker part of the year now, right? January was remarkably strong. February actually tends to be pretty weak. We often have a March low. Does that play into your thinking at all, or is it more just the trend in analyzing sort of price behavior over time?
Oh, absolutely. I trade seasonality regularly, and I love trading earnings, and that plays into that as well. And so, trading the January effect up into new highs, up into mega cap tech earnings season is something that I do every single year. And after we get through mega cap tech earnings, that's usually when the market pulls back. And I like to call that the fangover. Remember when we used to call these stocks the fang stocks? Well,
That's a new one. I actually hadn't heard that before. I like that one. The fangover.
We're there, right? You got to get ready for the fangover.
No, and that's kind of where we're at, right? I mean, this move higher really has been fueled by the mega cap earnings, the Meta's gapping higher double-digit percentages. That sort of boost to the market now kind of behind us. So the question is, right, what puts us higher? We have some earnings, Amy. You mentioned, and again, there's such a cyclicality to earnings, and I think you better than anyone really focus on that quarterly earnings pattern. Let's look at some of the recent names that have reported and just talk us through how you approach these, what you're seeing now. We're starting with ARM Holdings, ARM, which is a semiconductor name, big gap higher this week. What's the story here?
So when the market's extended, I really like to look for opportunities surrounding earnings season. Well, I like to look for opportunities surrounding earnings season all the time,
Anytime.
right? But especially when you're looking, you're saying, oh, what swing trades can I do? Well, look at the earnings calendar and look and see what's moving. ARM is a perfect example. This is a recent IPO. This is only the second time that they've actually reported earnings, but they had a massive move today. So for those of you out there who are looking for short-term trades on the market open, one thing that you can do is you can scan for overnight moves and you can see which stocks have made big moves after earnings. And this is a great example. This one's up, 48% right now?
Yeah.
So, if you're one of those traders that's sitting there, ding, 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 market open, and you see something in the options market, we look at what the expected move was, okay?
Right.
So generally, if a stock moves about 1.5 to 2 times what the expected move is, that stock is usually going to keep going. And this is one of those examples. So, for a day trader, that can provide some opportunity right on the open to get in for a high volume buy. And then, for your investors out there, this is just one of those things where it's just a great sign. Look at this space. It's continuing to grow. I think this is going to be a good year. And I think you can look at earnings reports and get a little bit of positivity out of them.
It's been a pretty good stretch for semiconductors for sure. I mean, name after name in this group have had these really nice moves higher with some exceptions, but overall it's been pretty good. The mouse has broken out. Disney reporting today and up 12%. That is another similar kind of thing, right? Gapping higher on earnings. How do you think about this sort of chart?
So when you're looking at Disney again, this is just another idea that you can see, and you can say, hey, you know what? This had a much larger than expected move. It gapped up. It continued going. So that's something that would provide an opportunity for someone looking to day trade. But for an investor, you have to look at Disney and say, 3 quarters in a row, this thing has gapped up. We're turning around now. We're breaking out. I was a bear on Disney for quite a long time, but when you have that earnings story changing the picture here, that means that it's time to get back into the stock. So I like this one, especially after it broke out above 100, up above that key psychological value. So I wouldn't, I'm not going to buy it here when it's already up 11% for a long-term investment, but certainly if you're looking for a spot, you can see and wait for a pullback. Be a great time to get back in.
You mentioned being bearish on Disney, and I think very well justified given the fact that it was in such an extreme downtrend for so long, right? But things have certainly changed from the left half of the chart to the right half of the chart. When you're looking at a name like this, what is it that rotates it in your brain from an obvious, underweight or an obvious downtrend to something that's more of an opportunity? Is it that first gap higher on earnings? Is it more rotating above moving average support? What tells you that story of rotation?
So it's going to be a combination of both. I mean, certainly with the technicals, I'm looking for price to shift so that it's above the key moving averages instead of below. So I want to see a break up above the 50 simple. I want to see a break up above the 100 simple. I want to see a break above the 200 simple. And then I want to see price staying up above those moving averages instead of below, right? And then when it pulls back, I want to see price bouncing and going higher. And oftentimes, earnings can be that catalyst to cause this to occur. And especially when you have 3 quarters in a row, it's not just a one-hit wonder, maybe 1 quarter where it didn't do terrible. Now we have 3 positive reactions in a row. So that creates a much better bottom than just 1 quarter.
It's a nice gap higher today, but really I think the latest in a move of improvement from a technical perspective for a chart like Disney. Let's get to some actionable ideas that you're looking at right now. Broadcom, another semiconductor name, really setting up at the upper end of the range. What attracts you to a chart like this?
So when you look at the market where it is right now, and we've had such a strong start to the year, it's really hard to find trades on tickers where it can keep going. And so what I like to do is I like to focus on relative strength. I like to focus on areas of the market that are the strongest and that are most likely to continue. And when I'm looking at what that is, Broadcom fits the cake, right? So you have Broadcom. Yes, it's been incredibly strong. I am an investor in this name. I'm not going to buy more shares at this level, but I love to trade this ticker because it has relative strength and a lot of power behind it. So I like to also target key psychological values in the options market. And I see that Broadcom has 1300 sticking out at me. So you have a nice little pullback into support. It bounced. It looks like it's getting ready to not only hit 1300, but ideally I'd love to see it break out and shoot up into 1350.
Yeah.
So for just a shorter term target, I'm going to trade this one into 1300, and then I'm going to see if I can push it into 1350. But be careful, because whenever you're pushing tickers like this, when the market's extended, you know, if it starts to turn, you're going to have to get out.
Be ready. Be ready, I guess, for anything, right? Great. And Broadcom, one of those classic examples of higher lows on the way up there, just this nice, consistent uptrend. Great example. John Deere's another one in the industrial sector, which is an area which has actually really improved. I mean, so many names you're starting to see improve in industrials after not really looking that way. What do you like looking at Deere? This is a name reporting next week.
So I'm always looking for opportunities surrounding earnings. And, you know, as you mentioned, John Deere has earnings next week. And what I actually like about this one is it's been pretty muted. So we've seen these massive runs in tech stocks, you know, AI names, in semiconductors. And so when I'm looking at my stock portfolio and saying, hey, I want to put some money to work, what can I do? Well, I can't buy NVIDIA after it's already rallied. Let me look for something that's been a little bit muted, that's been consolidating. So if you look at John Deere and look at this monthly chart, do you see how long it's been in consolidation? Yeah. Well, you can see down below that it's in a monthly squeeze. You see those red dots right there? What that means is that it's building up power, it's consolidating, and it's about to break out. If you look at the last few times that John Deere had that monthly squeeze setting up, and then you see the way that it broke out after the fact, those were the moments in time where you needed to get involved. And so for me, I'm looking at this in my long-term portfolio and saying, you know, I know it's been sideways. I know it hasn't been very exciting, and that's why I want to buy it. And I want to buy it now because earnings is coming up. John Deere has done really well, continually beating EPS estimates, continually increasing their earnings. I think they're in a great space right now. They're a leader in their field. So I don't know if, you know, this quarter is going to be the quarter that it will cause the breakout, but it certainly could be, because earnings often is the catalyst to cause the breakout from that squeeze.
The monthly chart showing this really interesting pattern of the squeeze and then these breakouts that have happened. Can you talk to us just for a moment as we wrap up about, let's say you do think Deere's an interesting opportunity, look at the daily chart. How do you actually time those entry and exits? How do you actually take action on a name like this?
Sure. So when I'm looking at a daily chart, I mean, generally I like to get in when price is up above the 50 simple. That's generally a pretty good spot. I also like to look for good price support. So if you look at John Deere, it's sitting pretty well at about 385. I mean, you can see that it's hung out around that zone for quite some time. If it broke below 385, especially below 375, I'd say, you know what, you know, we're probably going to pull back more before we go higher, and I'd look for the next zone of price support. But I think that this is a good spot. I think that it's holding price support on the daily chart. I think that the monthly and the weekly chart look good. The expected move over the earnings report is $20, and so when you look at the current price at 386, that means that that $400 price point and that key psychological value is within range. So what I often do in the options market is I will set up my trades targeting a key psychological value that's within range of the expected move on earnings.
Interesting.
Yeah, so I'll use a debit spread or I'll use a butterfly, and I'll place a target up at $400 for next week. And so that's a way that on a short-term basis in the options market, I can trade John Deere. And then on a long-term basis, I can just simply average into the shares, you know, 380, 385, with ultimately a target of about 475.
Got it. Great illustration there of the multiple timeframes on Deere there. Danielle, this was awesome. I'm so glad that you're able to come into to the studio. Hopefully there can be a regular occurrence now that you're local here in Seattle. So welcome again to the Pacific Northwest, and thanks again for coming in.
Thank you for having me.
Good to see you. That's Danielle Shay. Danielle's the Director of Options at Simpler Trading. Really fun to have her here in the studio. I hope you caught some of those discussions about multiple time frames. And even as we were talking about some of these names before we started the show, really talked about the relationship between earnings and some of the longer term trends. So recognize whether you're short term or long term, there are different time frames at work. So use a platform like Stock Charts to really understand the relationships of short term swings to long term trends and everything in between. Great take there by Danielle Shay of Simpler Trading. Folks, we've got to wrap the show. Let's go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. All right, so we're looking at the S&P 500. This is a simplified version of the chart that I use in our market recap. My daily S&P chart that we show every day on the show, pretty busy, and I guess I've learned to be a little more comfortable with showing you all of the ugly details because I think it's helpful for you to see day to day how we're thinking about each day's price action and how it fits into the overall picture of the S&P 500. But here we're just focusing in on trendline analysis. I did a webcast earlier today. Shout out to the folks at TD Direct up in Toronto. We had a really good discussion about behavioral biases and different technical indicators. We talked a lot about trendline analysis and what that might mean. And I drew an initial trend line, which is now a dotted blue line here off of the October low. And I think that served well, sort of indicating the initial pace of that trend off of the lows and then identifying this consolidation period that we saw from mid-December to mid-January. That changed when we broke out of that range, and it really compelled me to draw a new trend line or a secondary trend line from the October low to the mid-January low. Look how well that lines up with that third point. So let's be clear. The way you do this is you find the first 2 points, draw your trend line, and then look to see if it lines up with additional points. That's why this is a pretty valid trend line. The chart's telling you it's a valid trend line because we have more than 2 points that actually line up with the independent first 2 points that we drew. So now we have a pretty good proxy for the pace of this trend. In some ways, one of the easier technical tools you can use because you're just looking for that trend line to break. Every day, every week, as long as we hold that trend line, even with pullbacks, then the pace of this upward trend is fine and the primary trend is probably in good shape. We start breaking that trend line, that's where you need to look to the left on the chart, look for key support levels, look for moving average support, maybe use Fibonacci retracements, think about some of those levels that may be of interest now that you've opened the door, unlock the possibility of further downside. For now, the S&P is holding above that trend line. I would say the primary trend remains positive. Chart number 2, we're looking at a weekly chart of Disney. I loved today's guest, Danielle Shay, talking about some of the different charts and ways to think about earnings names like Disney. Big win this week with the stock gapping higher. This is a weekly chart of Disney going back to the last 7 years. And I'm looking at the unadjusted data. And on our platform, put a little underscore before the ticker, or on our new Sharp Charts workbench, just below the chart, unselect or deselect the setting that says adjust for dividends. And when you do that, you'll find this particular set of data. I'm using a Fibonacci analysis, taking the all-time high from 2021, the low from October of last year. And you can see, even with the gap higher on the daily chart, this still has a lot of daylight above current levels. And if you look a little bit further, we have the 200-day moving average currently around, this is actually the 150-week moving average, that is around 121, we'll call it. Just a little bit above there, 126.40 is also the August 2022 high. That's the first Fibonacci retracement. So now that we've broken out, that's sort of the upside objective that I would keep in mind, that first Fibonacci level. But we're able to break that. I mean, look at how much upside there is still. When in a world where so many stocks are continuing to make new highs, pushing the boundaries like Meta and Nvidia and others, something like Disney just turning around essentially in the last 6 months. So certainly some upside potential for Disney. Finally, the chart of Bitcoin. Again, my reminder on this chart is to focus in on big round numbers. I've talked to you about big round numbers before, which means when something like 40,000 comes into play, I immediately think if we're selling off to 40,000, I'd expect a bit of a bounce, at least a bounce off of that level, because it's just worked so consistently. And here again, we had this nice hammer candle right at the lows, and now we bounced back above there, which means as we push higher, I'm immediately keying in on that January high and also the Fibonacci retracements, the big round number of 50K, all in this green shaded area. I think there's your next anticipated level of resistance. But if we can get above that level, that's where we unlock the possibility of further upside. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. A special thank you to Danielle Shay of Simpler Trading joining us here live in the studio. Don't forget to like the video, and if you like what we're doing here with this episode, just subscribe and you won't miss the next one. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.